Welcome back to Investing Talk Podcast.
Today we're looking at Nebius Group.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Nebius is it's operating at a speed that honestly makes traditional tech growth look, well, flat.
Flat is a good word for it.
Yeah.
When you look at the fundamental metrics, the story is almost unbelievable.
It really is.
I mean, just look at the recent financials. Q3 2025 revenue came in at, what, $146 million?
That's right.
On its own, that's a decent number, but the context is everything. That's a 355% increase year over year.
Yeah, this isn't just growth. The company is literally being pulled forward by this massive wave of demand.
And that demand is almost entirely focused on one thing, right? AI infrastructure.
Yeah, this is not some balanced, diversified cloud provider. Nearly 90% of their total revenue is now coming from that one core segment.
Which itself grew, what was it, something like 400%?
Roughly, yes,
Okay.
in that same quarter. What this tells you is that Nebius is a pure play on the current GPU supercycle. It's all about that desperate need for specialized compute capacity.
And that strong Q3 is really just the warm-up act. Let's talk about the future, because the numbers management is throwing out there are what make this stock so compelling and, frankly, kind of terrifying.
They've tightened their full year 2025 revenue guidance to the 500 to 550 million range.
Which is respectable, but that's not the number that everyone's focused on.
Not at all. The number that truly defines this whole investment thesis is the 2026 annualized revenue run rate target, the ARRR.
Okay, so what is that number?
They're aiming for an astonishing $7 to $9 billion.
Wait, 7 to 9 billion. That's a potential 15 times jump from their 2025 numbers. That's
Oh.
I mean, how can any management team possibly project that kind of growth?
And that's the key. Because it isn't really a projection based on, a hopeful pipeline or general market growth.
So it's not just a guess.
No. It's substantially underwritten by committed contracted demand.
Right.
The key here is visibility.
Okay, so tell us about these anchor contracts, because this is the foundation of the whole bull case.
It is, they have two just enormous foundational agreements. The first one is a multi-year deal with Microsoft.
Right, the big one.
And it is huge. The deal is valued somewhere between $17.4 and $19.4 billion. And critically, it's structured to ramp capacity and therefore revenue heavily through 2026.
So that revenue is coming soon, not in 2030. And who's the second anchor tenant?
That would be Meta Platforms. They've got a $3 billion 5-year contract.
So you have two of the world's biggest buyers of AI compute locked in.
Exactly. They're committing tens of billions of dollars. These contracts basically pre-underwrite the vast majority of that planned capacity expansion. If Nebius can build it, the revenue is essentially guaranteed.
So if you're looking at that $7 to $9 billion target, you're not debating if the demand exists. You're debating if Nebius can actually execute the build-out to fulfill the contracts on time.
Precisely. And that execution capacity, that's the ultimate moat in this market right now. Nebius is emerging as this neo-cloud specialist.
Meaning they're not trying to be everything to everyone like Amazon or Google.
Right. They're focused solely on high-intensity AI workloads.
Yeah.
And the main constraint for everyone right now is capacity. Nebius's capacity is, quote, sold out. Demand is just fundamentally exceeding supply.
Which explains their incredibly aggressive, some might even say reckless, strategic land grab.
But that's why they raised their 2025 capital expenditure guidance, their CapEx from $2 billion up to a massive $5 billion.
Wow.
It's a strategic move to lock up the physical resources before their competitors can.
Okay, so if you're listening to this, you're probably thinking, where on earth does $5 billion go in 1 year? Why is it so expensive?
It's about securing two incredibly scarce resources at the same time. First, you have the data center shells and the GPUs themselves. But second, and this is the most critical part, is power.
The electricity.
Exactly. These massive AI clusters require huge amounts of connected power. That $5 billion is funding the infrastructure to hit a target of 800 megawatts to 1 gigawatt of connected power by the end of 2026.
A gigawatt of power is just monumental. That kind of thing requires long lead times, real estate. You need deep relationships with utility providers.
Right. This CapEx isn't just buying server racks, it's buying the right to participate in the AI arms race by securing a piece of the electrical grid.
And that infrastructure, once it's actually built, it operates with pretty strong economics, doesn't it?
Remarkably strong. You'd assume a company spending $5 billion up front would be deeply unprofitable.
Which, if you look at the net loss, it is. But we have to separate the construction costs from the operational reality.
That's the key distinction. Their core infrastructure segment, that 90% of revenue we mentioned, is already highly profitable. It achieved an adjusted EBITDA margin of nearly 19% in Q3.
So once a customer is hooked up, the service pricing is actually very healthy.
Very. The reported losses right now are just a function of this massive upfront investment in assets that haven't even been switched on yet.
So the equation is simple. Huge investment now for guaranteed high-margin revenue later. But to keep those customers from eventually leaving, they need more than just raw power. They need some stickiness.
And that's where they move up the value chain. They're not just selling commodity infrastructure. They've developed proprietary software layers, specifically the Ether 3.0 platform and something called the Nebius token factory.
Okay, the token factory. That sounds complex. Why does that create a moat?
Well, think of it this way. Renting a car is like renting raw infrastructure. But if you spend years customizing that car's engine and software to make it run 50% faster, moving that engine to a new car becomes incredibly costly and difficult.
So it makes it harder to switch.
The Nebius token factory is designed for optimized open-source model inference. It helps clients fine-tune and run their custom AI models at peak efficiency on Nebius's hardware. The switching costs just become prohibitive.
It locks them in for the long haul. Okay, that rounds out the bull case. Massive contracted revenue, a capacity moat, and sticky software. Now we have to address the elephant in the room. This level of aggressive expansion carries huge risks.
Absolutely. The biggest immediate risk is liquidity and cash burn. Yes, revenue is soaring, but the company reported a widening net loss of almost $120 million in Q3.
So they're betting the entire company on pulling off this CapEx plan.
They are.
So how are they funding this sudden $5 billion capital need?
It's a two-pronged approach. First, on the debt side, they issued about $3.75 billion in convertible notes this year, and they were issued at very low coupons.
The low interest rate is actually a powerful signal, isn't it?
It really is. It means debt investors are so bullish on the stock's future that they believe they'll make their money when they convert that debt into equity, the big external validation.
But the second part, the equity financing, that's where the pain comes in for current shareholders, right?
That's the at-the-market program, the ATM. It lets them sell up to 25 million new shares over time. It's flexible for raising cash, but it introduces unavoidable dilution risk.
And that creates an overhang on the stock price.
A huge one. The market knows there are potentially 25 million new shares that could be sold at any time. It puts a kind of soft ceiling on the price. As the stock rallies, the company might sell more shares, which dilutes the value for everyone else.
And beyond the funding, we have to flip the anchor contract argument on its head. The strength of the bull case relying on Microsoft and Meta is also the main risk: customer concentration.
Absolutely. When the vast majority of your future revenue relies on just two clients, you are exposed. If either Microsoft or Meta has project delays or shifts strategy, that $7 to $9 billion target for 2026 could be in real trouble.
And there are some more conservative voices out there pointing this out.
There are. Some analysts, like Morningstar, have labeled the company as having no moat. Their argument is that GPU infrastructure will eventually just become a commodity.
Right. They think the current valuation already prices in near flawless execution.
Exactly. If execution falters even a little bit, or if competition heats up, those healthy margins could erode and the valuation could collapse.
So let's look at how the market has responded to all this. The stock performance has been, well, a roller coaster.
A volatility monster is more like it. Shares are up over 200% year to date. They delivered a staggering 518% return over the past 6 months.
But lately, it's been choppy. We've seen a real consolidation phase, including a pretty big 30% pullback from the October highs. It's trading just under $100 now.
That pullback reflects the uncertainty around the capital intensity and the dilution risk we talked about. But one key indicator to watch is institutional ownership.
And that's been going up
Steadily. It's now at about 22% of the float. Large long-term institutions have been adding or initiating positions, which signals that the so-called smart money believes in the multi-year story.
Yeah. So for you, the listener, the next few months are absolutely critical. Let's run through the calendar.
Okay, so coming up quickly, we have the index ETF rebalance on December 18th. It's a technical event, but it can impact liquidity. Then you have the institutional buying window opening up in January.
But the main event, The one everyone will be watching is the Q4 2025 earnings release.
That's expected in late February 2026. This is the first major checkpoint. We'll get confirmation on 2025 revenue, but more importantly, we'll get the first real look at 2026 guidance and progress reports on that massive CapEx deployment.
And of course, there's always the speculative chatter.
Always. There are unconfirmed reports circulating about potential M&A or even new hyperscaler partnerships beyond Microsoft and Meta. Just rumors for now, but they reflect how intense this environment is.
So the story here is really one of high conviction married to extreme volatility. It's a hypergrowth monster built on massive, visible contracts, but with the caveat of tremendous capital intensity and execution risk.
Exactly. If they hit that 2026 ARR target, the current pullback looks like a tremendous opportunity. The risk is high, but the potential reward, given the scarcity in AI infrastructure, is asymmetric. It's a classic high-conviction, multi-year hold, provided they successfully execute on that $5 billion plan.
If you want to keep track of this volatile story and get our analysis on the Q4 earnings in February, make sure you subscribe to Investing Talk podcast.